Sponsored by Anthony Mendez.
AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us today. You can always call the show 800-516-1220 or email the show Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. This is the Real Estate Report, and we are live every Thursday night from 6 to 7.
We like to call it the drive time special. Sit in your car, relax, sit back, let that self-driving car do its job, and just listen to our show for the next hour.
I think you'd be surprised how few self-driving cars are out there right now. Does that disturb you at all that some guys just reading newspaper while you're driving next to them?
Not at all.
Not at all?
Automatic pilot's been on airplanes for probably 30, 40 years. So you're flying, the pilot's taking a nap.
Sure, okay. I haven't figured it out yet. I'm not quite used to it, but I'm old school.
Well, people are you got to remember, the human being doesn't like change. So anytime something changes drastically, most of us have trouble adhering to it.
Speaking of change, Fed, they changed the interest rate. They increased it another quarter. How's that going to play into your strategy in real estate, Gordon?
Well, that's the seventh time in the last 3 years the Fed has raised rates. And according to the outlook, they plan to raise rates another 2 times this year at the next couple of Fed meetings. 2018 has been a great year so far in real estate and in the stock market. We were talking earlier that you gave me a survey that said that the average Californian has gained $51,000, I think. Homeowner in appreciation from beginning of the year till now.
In a 12-year period, 12-month period.
12-month period. So that's pretty impressive, considering that not too long ago a lot of Californians were underwater. So not only have we came above water and now we're threatened, but now we're going past threatened and getting out of water. So it's kind of interesting. But that's the way to say sometimes time heals all wounds. But if the economy gets stronger, jobs, what the old president used to preach are prevalent. Matter of fact, there are many jobs now that are more jobs now that the people are actually applying for. Unemployment hitting all-time rate lows. So, you got to be bullish on this market. You got to feel good about where we are in this economic cycle.
Yeah, home equity increased 13.3% in the first quarter of 2018 nationwide. That was a study done by CoreLogic. That's overall representing 1.01 trillion gains since the first quarter of last year. It's incredible. What we're seeing, a lot of people are frustrated, though, that are sitting on the sidelines, whether they're sitting or they just can't buy. There's a little article that I read earlier today. This guy's an engineer, and he can't save fast enough for a down payment in order to buy a house, and he keeps getting overbid. In fact, we're going to get to it later. California, especially, the Bay Area leads the nation in homes that are not overpriced, but over asking price. It's like 86.3% of homes that are sold in, I think, Santa Clara County sell for more than their asking price. It's the highest in the nation. So a lot of people are sitting there wondering what's going to happen with real estate. Gordon, do you get the sense that if you're in real estate, it's great? It's like owning a Apple stock 20 years ago. But if you're sitting on the sidelines, you just want to get in. You just want to buy something. Is that a sacrifice? Because about 3 years ago, I was saying, people are just buying anything because it'll go up. Are they sacrificing too much? And now I'm starting to wish I never said that. Well,
it's a spectrum. There are different opinions depending on which side of the fence you're on, of course. I think if you own real estate right now and you're sitting pretty, especially if you're here in California, depending on where it is. Some places are prettier than some, but for the most overall part, our consensus is actually pretty. If you're on the sidelines looking to buy, in the last couple of weeks, we've been experiencing a lot of sad buyers. We've been writing a lot of pre-approvals, and we're seeing clients, especially in that mid-range home price, that $400,000 or $500,000. We're seeing the greatest demand in that area, and people are moving out further out, trying to become a homeowner. We've getting people outbidded. There's the client that we had. She came in yesterday. She wrote an offer on a house. They're asking $455,000. It looks like this morning it went over $600,000. It's a small 2-bedroom house in East Oakland. So, and as you sit back and you see that, it can be very, very discouraging. But we always say, we're at the end of the spring. We're about to hit. The summer is about to kick in. Summer is traditionally a slower selling month because a lot of people go on vacation. So we tell the clients, hey, listen, if you're still worried about buying a house, now's the good time. The opportunity might be here in the summer. So just hang in there and don't get deflated because of you've been outbidded and trying to get your offer accepted with your realtor.
Lawrence Yun, he's the chief economist at the National Association of Realtors. He says everything from the Rocky Mountain states and west from there are doing much better than the rest of the country, and it's been like that quite consistently. Places like Seattle, Las Vegas, San Francisco are leading the way in annual double-digit home prices, while the rest of the nation is averaging 6.5%. It's kind of a story on why California real estate is doing well. Tech sector, we're getting a trifecta. There's low inventory, we have high jobs, and we have a great place to live.
Yeah, we have high-paying jobs, actually. That's one of the biggest reasons why you're seeing that area where the Silicon Valley is people are employed are just going gangbusters as far as home prices are concerned because you have high salaries. A lot of times in parts of the country, they have a lot of appreciation, but they can't have the double-digit appreciation we have because they just don't have the economic base to support the high housing prices.
To buy a home in San Jose, how many days does a home sit on the market before it's sold? Or a contract.
If I was to bet, I'll say 5 days.
9 days. That's second to Denver, which is 6 days.
Okay.
6 days on the market. Okay. So low inventory and high home prices, and we're still getting appreciation. A lot of people are wondering how long this phenomenon will last, especially when home prices are going up faster than wages. What happens when there's more inventory hit the market? I think about that constantly, where I always end up is where are these people going to move, and if they're going to sell. We have to remember we have Prop 13, we have the parent-to-child and grandparent-to-child transfers. A lot of people are keeping their homes, and maybe they're cashing out a little bit, or they're getting bought out, and they're moving elsewhere. But that doesn't add more inventory to the market. How long do you see this happening before we see any kind of relief and more inventory?
Well, I'm beginning to actually, in the positive sense, as I drive through different neighborhoods in different cities, I'm beginning to see a lot more properties on the market, a lot more for sale signs, a lot more properties are come in signs. That's a big thing now with the realtors, come in soon. I'm beginning to see a lot of energy. So the energy, I think, is good for the market. I think a low inventory is good for a seller, but it kind of really stagnates the marketplace. The market works on change. We work on people coming in and people going out, and I think that's a healthy market. One of the things that you just mentioned just now that's important, you asked me the average day the house stays on the market in San Jose, 5. I said 5, you said 9. DOM, as we call it in the appraisal, days on the market is a good economic indicator of what the market's actually doing. In a slow market, when you're seeing days on the market, 150, 160 days, there's something wrong. That's not a very robust, flavorful market. When you're seeing those high days on the market cost, then you're probably looking at more buyers, more sellers, more buyers and sellers, of course. And then you'll see those properties stay in the market a little bit longer, and that's where you see the value of the markets actually start to come down.
I just don't see it yet, personally. I don't think you're crazy saying that. I think there's a mathematical formula that anybody could figure out the supply and demand and home prices, and I just see so many buyers out there waiting to buy. And you talked about the median home price. You said in the affordable range. I think that's probably what you should have said, 400, 500. But our median home price in the Bay Area is more like $800 to $850. And it's crazy to say that. I overheard you talking today about that $730,000 2-bedroom 1-bath. Who would buy that? A lot of people, Gordon. A lot of people would. They're getting the write-offs. They're not as much as they used to be, but they're getting the write-offs. They're still not record low rates, but low rates. We're 1.5% to 2% lower than our rates that we saw back in 2006 and 2007, and below our historical average. So we are seeing a lot of incentive for people to own, especially when rents are so high. The rent versus buy calculators online must be blowing up right now. We have a guy that's up in Sonoma right now. He's renting for $4,000 a month in Sonoma. And you can go look at an $800,000, $900,000 house, and it works out. Those numbers work out with 20% down. It's better for him to buy a house.
Well, actually, that's the market balance, sir. I think that as rents go up, there's no reprieval saying I'm going to rent unless you're locked into some low-income housing in a rent control market. So that's the issue. The equalizer is as rents go up, a lot of people now say, well, listen, if I'm going to spend $4,000, I'm going to spend $4,000 as a homeowner. I can get some type of write-off. I can get some type of appreciation. I'm not going to help a landlord pay off his property. But, June is National Home Ownership Month for National Association of Realtors. And this is where right now we're coming up in the mid part of the year, where today's June 14th. But by the way, today's Donald Trump's birthday. I pulled that up earlier, and I thought that was interesting. Didn't see a lot of news on it out there. But we're in the mid part of the year, the summer months. So like I said, I think the summer begins June 23rd, another week or so, the official start of summer. And I think as we're going to see the spring roll into the summer, and as tradition is all I can say. That's why we study history. Traditionally, a lot of people go on vacation. Traditionally, the summer markets are a little bit more slower. So traditionally, don't get discouraged if you're out there looking for a home. Now's a good time to keep putting your offers in.
Got to put that offer in there. Again, statistically, you're going to in the Bay Area, you're going to go over asking price, and you got to start that way. You got to work with a good realtor that understands that particular market. It could be even just that particular neighborhood. We talked last week. I said maybe you just go directly to this listing agent. That might be your only way to get your foot in the door, and that no pun intended, but and get that offer accepted. What do I need to offer on this house in order to get it? A lot of people come back though, Gordon, that the finances. All right, so we do the financing part, and we see a lot of people going, I only have this much money, and I want it to be 20% down. My rate will be higher. My payment will be higher if I put less money down, and I buy a bigger house or more expensive house. But there's a lot of products out there incentivizing this. There's up to 95% jumbo loans without no mortgage insurance. First and second loans to 95%. FHAs, the FHA, Fannie Mae, and Freddie Mac, they've all increased their mortgage limits here in the Bay Area to $679,000. That was a great number, by the way. It was like $51,000 higher. And it almost seems like nothing is helping these buyers.
Well, it's affordability. One thing is affordable housing is a key thing. That's the reason why beginning January 1st, every time you refinance a house, every homeowner refinance a house to pay affordability fee to the state. They're supposed to be building up this bucket of monies to help affordable housing in many of the cities that are suffering. They're saying that a lot of people are becoming homeless because they not only can afford the high rents, but there's no other affordable place to go and to still maintain employment here and family life in the Bay Area. It's a sign of the times. I always tell people whatever goes up does come down. And right now, when the market is rolling upward, there are a lot of people that kind of get crushed and get priced out. But if the market comes back and resettles itself and reshifts itself, there will be an opportunity for those people to get back in the marketplace. I tell people don't panic. I think if you have a consistent game plan and you consistently focus on what your overall thought and strategy is, I think you will become a homeowner because whatever does go up does come down.
Credit availability climbs to 3-month highs in May. That means that it's easier to get a loan than it was last month and the month before and the month before, and certainly better than it was back in 2011. So the availability of credit is out there. It's the best it's ever been since it's the best it's been since mid-crisis.
Once again, tradition. We always see as rates go up, it's always easier to get a loan when rates are very, very low for some reason. Lenders get real stingy as far as handing out that money.
We'll come back after this break here on AM 1220 KDOW. This is Tony Mendez and Gordon Hines. This is the Real Estate Report. You can always call the show, 800-516-1220, 800-516-1220, or email tony@bayarealoansource.com. We'll be right back.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us. Follow the show, 800-516-1220. We did get a couple emails. We'll get to those in just a bit. Meanwhile, mortgage interest rates are slightly up from last week's, 4.62% for the 30-year fixed, according to Freddie Mac weekly survey. It's really just a trend of what things are doing. Your rate's going to be whatever it is, based on your credit, your equity, the type of property, and type of transaction, and so forth. 15-year, 4.07%. Oh my gosh, remember when that was below, the 15-year was below 3%? Wasn't that long ago?
Wasn't that long ago?
Yeah, less than 3 years ago. 3.83% for the 5-year ARM, so that's 0.8% lower for an ARM. And a lot of people are looking at ARMs right now. A lot more people are going, tell me a little bit more about how that ARM works. They're pretty simple. They're fixed for that period, in this case 5 years, and then it adjusts to your usually yearly, to your margin and index. And if you have an ARM right now, you're probably seeing that rate go up. Because the LIBOR, have you seen that LIBOR? One of your LIBOR is at 2.6 or something like that. If you have a margin of 2.5 or 2.75, you're over 5%. And you're like, oh no, I should get out of that. Because mortgage rates are still lower than that.
Yeah, we just mentioned some of these
30
earlier that I thought was interesting. A lot of times people listen and people shop for rates, and they hear these great, fantastic rates being advertised. And then sometimes we get calls, and when I give them the rate, wow, you're so much higher than what I've heard on the radio or television. And I tell people everything in our pricing engines that we use, everything is risk-based. There's a premium for non-owner. There's a premium for how much you put down. There's a premium for your credit score. There's a premium for a dollar amount. So all these things actually factor into the actual market rate. So a lot of times it's not like when you call a lender to debate and switch you.
Those advertised
rates
rates
you have to really understand the marketplace to figure out what you're actually getting and comparing to make sure you're comparing apples to apples.
Half of those online quotes have really high APRs compared to their rate. And that means that you're paying points. Even though it doesn't say points, you're paying some sort of cost to get that APR up higher. So be really careful about what you're reading and seeing online, especially anything that looks below. Go to Freddie Mac PMMS, Primary Mortgage Market Survey. If you're getting a rate that's near there, you're pretty good, and feel good about it. I did it just recently on a rental property. And I got the going rate for a rental property. I was like, okay, let's sign off. Let's do it. We're done. We're not going. That's not our topic today. But you're welcome to shoot us an email if you have any questions about your ARM or any kind of refinance or purchase and rates and things like that. Tony at BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. So we were briefly talking about in the last segment about home equities increased 13.3% in the first quarter 2018. That represents about 1.01 trillion in this first quarter, according to CoreLogic. A lot of people are being pushed towards second loans, and it's up, Gordon. It's up from 16% from the last quarter of people getting equity lines. What is it? And especially after you can't write off the interest anymore on these. What's going on with this?
Well, people are getting equity lines for one reason only.
Easy,
the
fast
lenders
cash.
Are pushing equity lines. By the time you walk into the bank, the teller's going to ask you, hey, do you have a home equity line of credit? They're making it easier to get. Anytime you give anything, make it easy, people are going to go for it. It's like the free cheese period that we came out of 2005 and 2007. So that's the reason why I got an article here that says mortgage originations are down for the month of May, but HELOCs are up 18%. And the reason why HELOCs are up 18% is it's easy money. You need to get to it. It's not a real estate loan. It's a consumer loan. There are good benefits to having a HELOC. And once something is pushed in our face, we tend to take it because we look at free cash. It's like credit cards. You get all these credit card applications in the mail offering 3, 4, 5, 6, 7% low percentage rate, but you got to read the fine print. And most people apply for those cards and do the transfer balances, and then a year later they want to know how they get back up to 29% because they don't take time to read the fine print. You got to qualify what you're reading, qualify what you're actually buying as a consumer, and that's why we're here, to make you a better informed consumer, so we can help you make a better decision. That's why a lot of people listen to the show, and that's why we really, really appreciate all the emails we get in regards to that information.
Yeah, it wasn't 16%; it's 18% from the previous quarter and 14% more than a year ago. Okay. Now, be very careful about equity lines. You have to look at your first thing I do about an equity line is analyze how fast I can pay the money back, because it's going to be a higher rate. The average rate for an equity line right now is 5.6 and some change. So if you're borrowing maybe $50,000, I think I'd be okay with an equity line. Okay, especially if you have a low first rate. But if you're looking at $250,000 and you have a $250,000 first loan at 3 point something or even 4%. And you figure out what your aggregate rate is, you might want to just take the cash out of your primary into one loan, and you get the write-offs, which is as long as you're married and you can get the full amounts there. So you really have to run the numbers. This is what we do. We can help people figure that out.
We can run those numbers for you, the better way to put it.
800-516-1220, get your calls on the air, or you can email us, Tony at BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. We'll be right back after this break. This is Tony Mendez and Gordon Hines.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Going to call the show 800-516-1220, 800-516-1220. Make that phone ring. You can email Tony at BayAreaLoanSource.com. Sales are slumping again for new homes. The Mortgage Bankers Association is projecting a decline in new home sales even more as it looks at all the application rates, and they're dropping 4% from last month. And then you have things like builders saying, well, it's getting more expensive to buy land and get workers. And now we have this thing going on with Canada, and now lumber prices are starting to affect home builders. We have a lot of calls of people looking at new homes nowadays. And they're all over the state. And we're working with a client right now looking in San Diego. And he's looking at a condo near the water, and he's trying to figure out if it's going to be a second home or not. He's getting a job down there. And I think we talked about that last week where, how do you get a house in a different location when you don't have that job yet? Do you buy it as a second home? Can you afford it? Can you qualify for your rent or your mortgage and the new home? But a lot of people are looking at these new homes. And you are paying a premium. I think on average, Gordon, I think it's like 20% to 25% more you're spending for the identical house, used or new. And people are wondering if they should pay that premium. But the more you think about it, when they're not building that many homes, that we saw a guy last year. He went into contract, took him 1 year for that house to get built. And people were offering him hundreds of thousands of dollars, $200,000 to be exact. That was his highest offer to take his place to buy that house. And he never even lived in the house. So there's these premiums going on these homes that are being built because some of them are actually in decent locations. Now, they might be a townhouse or a condo. Not a lot of single-family homes being built around here, unless you want to drive a little bit out 4 or 580 or 80. But we talked about this earlier. Would you put your money into a new home knowing that you're paying a small premium on the fact that it's new? But then you look at numbers that say that not a lot of new homes are being built. That's another inventory problem.
Well, a lot of people like new homes, and I've been in business for a long time. And one thing that a lot of people say, reason why I like a new home, no one's never lived in it. I can customize it the way I want it to be. I don't have to accept when you buy a resale, the same thing. I can redesign my yard the way I want it to be. New homes, it's a different flavor when you look at a new home, new community, new streets. A lot of these homes now have community pools. You don't have to put a pool in your own backyard. You have community courts. There's small associations that come along with a lot of these places. They seem when there's an association connected to a new home, the neighborhoods tend to stay up a little bit longer because a lot of these things, they cover front landscape and they have rules and regulations, CC&Rs, can't park on the grass and those kind of things. So those are some of the benefits of the new homes that we're seeing. The good sign, you can always tell if a builder's having trouble moving inventory. Anytime they're willing to pay an outside realtor to come in and bring their buyers, they're having trouble moving inventory. A lot of times they just want to give their realtor a referral fee. So that's a good indication what the market's going to do based on what the builder's doing as far as offering the incentive to the agent.
A lot of people that have looked at new homes know that those builders are requiring that they get pre-approved through their preferred lender or their in-house lender. And then they start throwing out these big numbers like $5,000, $10,000, $15,000 in incentives. What are your thoughts on that, where you've been working with maybe a bank or a broker for a long period of time, and then you call them up and say, these guys are offering me $10,000 for da-da-da-da-da. Can you compete with that? In reality, the answer is yes.
Well, I've actually, I'll be honest with you, I've lost deals to the builder because of the additional benefits that at that point in time they were able to throw in that we weren't able to throw in. So therefore, their overall package was a little bit more attractive to the buyer than what we were offering.
But you end up with a higher rate in a lot of cases.
Yeah, but the builder puts a lot of pressure on the buyer, and the buyer is not really an astute buyer, don't understand finance, don't understand what the rights and the do's and don'ts are. A lot of the time they can't acquiesce to the builder. But you have every right to do whatever you need to do as far as getting your own finance. You don't have to go for their financing. They like to give you a package deal because they figure if they can control the deal, they're more likely the deal's going to close. But
that's usually what it is. They want to control, and the new homes that we've done, and we get calls practically every day from the assistant or the coordinator. Where's your loan? Where's your loan? Where's your loan? Anyways, we'll come back after this break. AM 1220 KDOW. Tony at BayAreaLoanSource.com is my email.
This is Money 2.0 on AM 1220 KDOW.
Welcome Welcome back to the Real Estate Report. I'm Tony Mendez.
And I'm Gordon
Maybe
Hines.
I'm foolish, maybe I'm blind.
You can always call the show 800-516-1220, 800-516-1220. It's kind of a busy week in news. You know, we had the Fed raising rates. There's constant barrage of
Emails
news.
and questions. People always ask, what's going to happen to my rate?
Yep, that. But you know, usually what we see is that's going to hit people's equity lines first, and then it's going to hit their credit cards and their car notes. And believe it or not, rates are about the same before the raise. I can hear that, by the way, what you're doing.
Well, we always tend, anytime the rates go up, you get those surges, but you see them really on the consumer side of the loans first. The credit cards, you start to see your interest rates go up. If you have adjustable mortgages, you start to get those letters saying on the next adjustment period, you're going to expect your rate to go up. Those are the things that are first sign of rate increases. Traditionally, the mortgage rates will follow. It takes a little while because the market, works on time and it doesn't happen overnight in our business. But we will see those rates affecting your home interest rate. If you have fixed rate loan, it doesn't matter what the market does. You're fixed in, locked in for that period of time. You get 15 or 30 year, you don't have to worry.
And they're expecting to raise rates again later this year, at least once, right? So I think we're heading towards a higher rate environment, and I think people need to start thinking if there are any kind of adjustables that they're in, and that includes equity lines and ARMs. And if you're purchasing a house or you're refinancing, what are your options? We know people that just do ARMs because they're always getting a rate that's lower than 30-year fixed. Now, is the ARM rate today lower than the 30-year fixed rate that you could have got a year or two ago? It's about the same, but they could have had an ARM that was even lower, which they did, and that pays them throughout that period of time when it's fixed. So I don't have any predictions on how we're going to go through these troughs and over the next few years. In the past, it used to be about every 7 years we'd see rates go up and then come down, go up and come down. And you kind of pick and choose where you want to end up on it. Get an ARM when rates are high, get a fixed when rates are low. Now we're kind of right in the middle.
It's an economic cycle, and there's people out there that does a lot of forecasting on what the economic cycle is going to be, how long the trend is going to continue for rates to continue to rise, what's inflation going to do, what the world economy, world events is going to actually do to our marketplace. We're in a global economy. Everything that happens in our marketplace triggers into economic news. Sometimes we hear some bad economic news. We see spikes in the real estate rates. We see spikes in the market. We see big sell-offs. And then after the news become settled in or accepted, you'll see those sell-offs start to come back again. People start to rebuy stocks, and you see the prices come back up. So it's a cycle of what we involve in. I always talk cycles are good. Market moving up and down is healthy. No more stagnant market is not good. A high continuously rising market is not good. A continuously falling market.
I think we're in uncharted territory, Gordon. I don't even what I meant by I can't even predict what's going to happen. I don't know what's going to happen with home prices. If we keep our inventory low, is it always going to be that way? Can people afford to move somewhere else unless there is a huge correction? And that I think, and then you have the whole story about inventory elevating home prices, and we still have a good economy, 3.8% unemployment. So, and on top of higher interest rates here done by the Fed, we have the ECB. They're announcing that their massive bond buying program is likely going to end in December. Not only that, they're going to decrease in the last 3 months of the calendar year. They're going to decrease what they promised of $50 billion, and it's going to drop down like $15 billion instead, that they're going to infuse into their market. So that could cause interest rates to go a little bit higher as well.
Well, I mean, we're not gurus. We don't have a crystal ball, but what we talked about earlier. In our professional opinion, you look at the economic indicators. And one of the great economic indicators I mentioned are days on the market. When you see small, short days on the market, you're in a seller's market. That market is prices are high. When you see those days on the market, property stay on the market longer and longer, now the buyer's market's coming in. Prices are coming down. People are waiting. It's a cycle, basically. I can't tell you when they're going to come down, but we know they will.
Still trying to figure out what a lot of people in our industry say when they say it's hot market. At first I heard it in this type of seller's market. I was like, oh yeah, it's only hot for the sellers, but it's also, if you can buy a house, and when you buy that house, I don't want to be that pessimistic. When you buy that house, you're in a hot market. So that's the other part of the equation, is that everybody wants to get in and catch on that wave. We did get an email from Carl in Berkeley. And you can email the show, Tony@BayAreaLoanSource.com, info@BayAreaLoanSource.com, or Gordon@BayAreaLoanSource.com, not necessarily in that order. Carl's been renting for several years. He's saved about $50,000 for a down payment. All the houses that he's looking at are around $1 million, so $50,000 is 5% down. Are there any better options than a 5% down jumbo? He's afraid of getting mortgage insurance. Well, we talked earlier in the show. There are products, and we're looking at this chart right here from credit availability, and it's going this little chart. It's going up, 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 meaning it's easier and easier to get loans. Most of the improvement that we're seeing is in the jumbo territory, the jumbo markets. So there are products you can get that are 5% down for a jumbo up to, I think, $1 million, and then you can go up to 1.5 with 90% down or 10% down. But you have to have really good credit scores. If you're even considering this, Carl, check your credit score first. You have to have reserves. You have to have 12 months reserves of what they call PITI, which is kind of crazy. If he has 12 months of PITI reserves, which it's easily over the $50,000. $4,000. Let's say it's a $5,000
he can afford
payment.
to put down 10%.
He should be able to put down 10%, but he still has to have those reserves. So they could be in a 401k or IRA. He doesn't want to touch them. And you have to have trade lines too. So they're making it really strict, but they're opening the doors for these types of products. So Carl, thanks for the email. I appreciate it. Sandra in Redwood City, she bought a rental property several years ago, Gordon. Property needs a lot of repairs, so it sounds like it won't pass an appraisal. It's due to age, and she needs some upgrades. We can't find anybody offering a second loan on a rental property. And equity lines, those lenders are notorious for not doing appraisals. They just kind of do a drive-by, or they do what they call an AVM. Should we refinance and take cash out instead? So if you are lucky enough to find a really super high interest rate on an equity line for your rental property, I would consider maybe just doing a refinance, taking the cash out, look at what the rate would cost you, see how fast you can pay the money back, and get see if that works for you. Or you'd be re-amortizing too, and if that helps your cash flow, and maybe you can raise the rents.
Well,
I think that's also or the Fannie Mae home style, which you can actually do on a rental property if it's a single family.
Well, the great thing I listened to when I listen to stories or emails like that, see the client that have options. There are many options out there that are available. Traditionally, you have equity, you've got your property owner, you got loan to value. There's an option out there for her. So we'll give her a call and just go over a better answer for her.
Yep. Thanks for the email. You can always email the show, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. The website is BayAreaLoanSource.com. We'll be right back after this break here on AM 1220 KDOW.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us. I want to mention a seminar that's coming up. It is a Rob Black seminar. It's Thursday, June 28th, 2018. It's at 6:30 to 8:30 p.m. at the Palo Alto Elks Lodge in Palo Alto. You can join Chad Burton and Rob Black for discussion on the issues that can affect your retirement plan. And Rob will discuss market conditions, his favorite sectors, dividend stocks, and so on. You can sign up at robblack.com. I will be there. It's a fantastic seminar. It's been an ongoing seminar, I think, series for at least 11, 12 years. Oh, no, I'm sorry, 14, 15 years. Get them while they last. Go to robblack.com to sign up for that. Nation's top 3 most expensive places for renters. Guess where they are?
California?
No, even more specific, the Bay Area.
I was going to say California.
You have to make $50 an hour, or roughly $100,000 a year, according to a new report, to buy in the South Bay or to rent in the South Bay. You have to make $60 an hour in San Francisco, Marin, and San Mateo counties. In East Bay, it's only $45 an hour. So if you make $45 an hour, you probably move into the East Bay. 7 cities across the United States that are actually having falling rents include places like Seattle, believe it or not. There was a gluttony of new apartments that were built. And you see that every time, Gordon. Whenever you see that kind of real estate growth and home prices, and rents going up and jobs being created, you're always going to see that kind of building. The Bay Area went through this back in the 90s. In fact, we were the number one. We were leading the nation in multifamily building for quite a while, and we didn't build enough, unfortunately. Let's see, Baltimore. Not a lot of people are going to move there. Chicago, that went down as well. And I think I lost the other part of my page here. but Seattle was one of them. So, Portland, prices dropped in Portland and Seattle due to a large part of the flood of new apartments hitting the markets. Portland saw a 2.2% decrease. So, there's some places that's your supply and demand. And we're still seeing that in the real estate market. Buy a home, single family, townhouse, condo, doesn't matter. There's not enough in the Bay Area. I kind of usually at the end of a show start talking a little bit of philosophy here. And if you're looking to buy a house, start early. Start thinking about ways to cut your budget and save some money. Start working on your credit. Clean up your employment for the last couple of years. Even though we are seeing some lenders asking for 1 year's tax returns or one paycheck and maybe a W-2 from the prior year. There's a lot of ways that you can start. You just start early.
Yeah, we always talk about be prepared. The old Boy Scout tradition. We are seeing lenders, like we mentioned earlier, ease up on credit, asking for less things. I think loans are beginning to get easier to close, as we always predict. As rates go up, we always tend to see that trend happen in the marketplace. You mentioned earlier about apartments. Oakland right now, if you drive through the city of Oakland, there are a glut of apartments going up all downtown. So I kind of predicted the same thing. As those apartments get closed and then start competing against each other, you will begin to see rents come down because there's now more supply than actual demand.
I'd like to see rents come down a little bit so that people can start saving and not freaking out about how much the rent's going to go up the following month. And it really kind of stinks. Here's a little side note. If you are renting and you are looking at a jumbo loan, they're going to ask for 24 months of rent. And they're going to go back. If you're not renting from like a large company and you say it's a private person, make sure you document all of your checks and do a direct withdrawal, because that is the best record you can give to a lender. But and that's a guideline that these lenders are really sticking to, Gordon, and you can't get past it. So be very careful about what you're doing as far as recording how much you're paying. Just don't pay cash. So thanks for joining us. You can always reach us at Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. Our website is BayAreaLoanSource.com. Thanks for joining us. Don't forget about that seminar that's coming up in a couple weeks, Thursday night. Go to RobBlack.com to sign up for that. I will be there. Any last words, Gordon?
Another great Thursday, June 14th. Another Thursday under our belt.
Thanks for joining us. This is Tony Mendez and Gordon Hines and the Real Estate Report here on AM 1220 KDOW.